Welcome to Forte Asset Solutions Market Commentary 2012. This is the 18th commentary that I've done over the last 9 years, and we're going to be focusing particularly on the last 6 months of 2012 financial year. We're still operating within that backdrop of cash is king, high amount of fear factor around oscillating markets, and also a new FOFA regime. What we've seen with the cash orientation is a lot of innovation and product development, particularly in the areas of annuities. But what's also happened with the focus on cash is that it's actually increased, from a practice perspective, the fee for service. So whilst we had that impetus with FOFA, we've now also got the changing to fee for service to incorporate the ability to provide advice on cash and also be paid appropriately for it. I believe this is both good for the consumer, in that all of a sudden there's some real choice and management coming to play in what was really considered to be a dormant sector. But also I believe it's good for the practice development and business values as well. What we're seeing is not only innovation in manufacturing product, but we're seeing innovation in software. But this time it's different. It's coming from a practice perspective. Rather than the software providers externally, what I've now seen is that there's been innovation coming from advisors, and this software is going to be made available in the immediate future for other advisors, particularly in the area of client engagement. The software that I've seen appears to be and looks like and can be utilized as an app and can be used from a phone or an iPad. What it does is it engages the client in the process, not only for the initial fact find, but beyond. This software effectively elevates the conversation, particularly in quarterly reviews, from portfolio performance, or lack thereof, to all of a sudden about the achievement of the goals and other family-orientated discussions. For instance, bucket list achievements and things like that. The software is extremely accessible and also will interface with the two major providers. Another area of innovation within software has also been coming from the commission reporting and workflow systems and reports as well. This is leading to greater practice efficiencies, but also in the next 12 months, when all of a sudden we're going to have to respond as to the clients as to the total fees that are being charged. The product providers have no solutions, nor can they, because they only see one part of the overall portfolio. The dealers are struggling with this concept, but this practice has developed a software which is extremely sensitive. It can pick up family-related investments as well. It can also pick up the amount of activity from that particular account, so you can actually see profitability performance as well. So whilst from the outside looking in, our industry looks dormant, it's actually been a period of great innovation and I think really exciting advances for the future. The area of software development is also going to the point of scalable advice, where the consumer can now come in and instead of receiving a total package can actually select parts thereof, and it can be appropriately priced. This has been one of the challenges for our industry in re-engineering to the FOFA regime, but I think there are solutions out there. And it gives me great hope for continuing business, and particularly new business. My great fear has been is when the tide has gone out, as we've experienced over the last 4 years, many people are waiting for that tide to return. But I actually think it'll be completely different. The old business models will no longer work. We actually have to seek new ways to engage the clients. And particularly I believe that we'll see a continual rise of direct investments. Whilst we've seen the rise in self-managed super funds, I believe we'll also see that rise in consumer-led access in investment as well. And so I think that business models must change, and it's those business models that are showing that they are changing, that have the systems and process in place, that are achieving the greatest premiums to date. We've seen a shift in the face of distribution, or the face of the advisory market. We now see up to 90% of all distribution is now controlled by the institutions. And so this is where I think that this innovation also is required to show, instead of having homogenized advice, we're going to have individually tailored advice and individual plans that will not look like the other plan down the street. And I think it's this customization which is going to be essential to business success. So we have no organic growth, and in the absence of organic growth, what we're looking at is inorganic strategies, and what's coming to bear is acquisitions. This is being primarily led by the institutions. We recently saw the acquisition of Plan B by IOOF. But what we're also, and probably that's unseen, is that many of the institutions are extremely active at the coalface. For instance, in Victoria alone, one organisation has 6 BDMs out in the marketplace looking to acquire or to move over practices into their dealership. This is unprecedented activity, and this is the turf war that's going on between primarily 2 organisations, but certainly between 5 different organisations that are all battling for the same fund. What we're doing is cannibalising the existing fund. Now, there is opportunities for advisory practice within this. However, with the domination of institutions, I think what's really is required is for individual tailoring, for you to be looking different from the rest. And again, this is where I believe that the take-up of software is going to assist many practices. It has been reported that we are seeing the death of the independent marketplace or the boutique marketplace. I don't believe so. I think what we're seeing is really a back to the future. We witnessed this in the early 90s and the height of the recession. And what many practices are looking for is really a safe port to weather the storm. And the institutions are a very good port to do that. The lowering of costs, particularly in the area of PI insurance, for instance, plus the additional services that they bring to bear. And this is why they have a compelling value proposition in the current environment. However, for the boutiques to succeed, they really need to come out with a point of differentiation as well. And quite often that point of differentiation is the culture. What I think we will see is once we come out of our recessionary mode that our industry has experienced, and we see the return of organic growth, I think we'll continue to see the growth of boutiques again. FOFA is still a shadow over our industry, though most people are working within that. We have some challenges, in particular in the treatment of volume overrides with regards to the dealer and the ability to hand back down to the advisory practices. Additionally, we have some area of grey as to the grandfathering clause, particularly after a transition. However, most people are working under the assumed assumptions that they will be continuing. And because of that, we're seeing confidence has returned back to the marketplace. The independent marketplace is moving to copy the larger institutions and moving down the value chain, and so now they're having in-house single administrative systems and also participating in the manufacturing line as well. And I believe that to be in many cases appropriate, and in some cases the only solution to the FOFA impacts. What's been happening with this marketplace, and particularly with the activity of the large institutions, is that we've seen a scarcity factor come in. Supply has been down. And the reason for the less supply, and particularly from a Forte perspective, has been because of the success of the institutions. But also many are deferring any retirement plans simply because their superannuation is down 20%, aligned with the 20% reduction in revenue in their own practice, therefore 20% reduction in practice value. And so many have deferred sales. And therefore, because of the lack of supply, we've actually seen a reversal in prices where for the first time in the last 9 years, running up to the 6 months through December 2011, we saw businesses average multiple below 3 times. We have seen that revert, and we've seen the stabilization of prices in the last 6 months. A phone conversation I had recently is probably the best tell of the market environment. I took a call which nominated that, Steve, I have to buy or I have to sell. And I asked why that dichotomy. And the solution was the answer was that there's more money going out than coming in. And so if I was to acquire a $200,000 book of recurring revenue, pay $600,000, debt servicing would be $60,000, therefore I have free cash flow of $140,000, and therefore would be able to meet all liabilities. However, if the practice principal was not able to buy, then they would have to sell, and many are in this situation. And so I think that's probably symptomatic of the market that we're operating in the moment, and this is why we've seen a significant increase in the demand for book sales. That demand has led to a rise in the last 6 months. Running to December, the average was 2.88 times recurring revenue. For the period concluding the 30th of June 2012, the multiple was 3.01. However, with a twist, what we've seen, and it's the first time that we've seen it, is that individual revenue streams are being priced accordingly. Self-managed super fund advice fees are gaining 3 times. However, self-managed super fund administration fees are on 1 times. General insurance, 1.9 times recurring revenue. Risk, 3.5. Again, due to the scarcity factor, but also the stability of that revenue stream. Personal investment, 3.5. Corporate super, 1.5 times. Personal super, 2.69 times, but there's an anomaly to that, which I'll explain later. Personal superannuation insurance, 2.5 times. Accounting, individual I returns, 60 cents. Compliance or BAS, 80. Corporate advisory, 1 times maintainable earnings. And self-managed super fund administration, 1 times. And so we had an average for the 6 months as 3.01. The distortions that I mentioned is twofold. One was that a transaction by an institution of a book that I was representing was done at 2.75 times. However, the terms were such that was acceptable, because the terms was 50% upfront, but 50% paid in 90 days. So the 2.75s, taking a net present value, was acceptable from a vendor's perspective, also with the risk of any client defection, given that the limitation was over the 90 days. Another distortion that came in is that one practice was valued on its depth of those relationships. And so we actually saw a range from 1 times for passive clients up to 3.5 times. And I believe that what we're likely to see is a lot more focus on the individual revenue streams based on their level of client engagement. And this is going to become more and more important. The software system that I spoke of earlier actually has the ability of giving us that sort of depth of knowledge as to what the relationship is, how many points of contacts there are with the clients. I think that that'll be a rising and move from a trend to actually become maybe a discipline going forward, particularly in the next couple of years under the FOFA regime, where there won't be grandfathering, will be diminishing. So, in conclusion, we have seen innovation. We've seen it probably the first time for many years within the software area, which gives me great confidence for future values and the ability to better manage its practices. We're seeing this turf war. We've seen the impact on the supply, and therefore we've seen an increasing in demand, and so we've seen the stabilization of prices. It is a period which is extremely difficult, but it is also a period where we actually are seeing businesses re-look at their models and start to shift and change their models, in some cases with the use of new technology like social media. Even Forte Asset Solutions is about to embrace social media, and the hope is to improve our service level to buyers. We'll now be able to list and notify buyers via LinkedIn and Twitter, as well as our website, of new opportunities that we're bringing to market. Forte is also moving up in the world, only one floor, but from level 5 to level 6, 99 Queen Street next month. I look forward to continuing to deliver service to both buyers and sellers within this market, and wish you all the very best. Thank you.